and welcome to Tradewire. Today, we're going to dive into the topic: what happens to markets if the Supreme Court strikes down President Trump's tariffs? A Supreme Court decision could reshape global trade and shake financial markets overnight. Legal challenges to President Trump's sweeping tariffs are moving through the courts, and if the Supreme Court ultimately rules against them, we could see ripple effects across stocks, commodities, supply chains, and consumer prices. And Trump has already signaled if tariffs are struck down, he'll figure something out. So, what happens next? Let's break it down. The core legal fight centers on whether the president had authority to impose broad tariffs using emergency powers. A major case, VOS Selections v. Trump, already resulted in a lower court ruling blocking tariffs, saying emergency powers law did not give ultimate tariff authority. Businesses and several states argued tariffs were imposed improperly under the International Emergency Economic Powers Act, or IEEPA. Meanwhile, the administration has argued tariffs are regulatory, not tax raising, even though critics say only Congress can impose revenue generating tariffs. The Supreme Court is expected to ultimately decide the legality, potentially by the end of the term if it takes the case. So let's look at market scenario number one: if tariffs are struck down. If the president's tariffs are struck down, the immediate winners are expected to be import-heavy companies like retail, consumer electronics, global supply chain tech, and logistics and shipping. You may ask yourself why. Simply because costs are expected to drop immediately. Margins would expand and supply chains should normalize. Now, potential stock tailwinds could hit mega cap tech with global manufacturing, retail importers, e-commerce platforms, and transportation and logistic firms. Lower import costs can also reduce inflation pressure, which could push bond yields lower and help growth stocks. The potential losers could be domestic producers protected by tariffs, including steel industrial manufacturing and certain U.S. commodity producers. Essentially, if foreign goods become cheaper again, domestic pricing power weakens. Let's now tackle market scenario number two: the government response if tariffs are struck down. It may not be the end. President Trump and advisors have hinted at the alternative tools. Possible fallback strategies could include national security tariffs, trade practice enforcement tariffs, and targeted country-specific duties. We all know markets hate uncertainty, so even if tariffs disappear, volatility could spike while investors price in the next policy move. Now let's look at the macro market impact. The big picture means this: if tariffs disappear, there would essentially be lower import prices, potentially lower inflation, and stronger consumer spending, but also there could be government revenue impact, possible tariff refund complexity, and global rebalancing. Supply chains could shift again, especially if companies had already reshored manufacturing. So what is the investor takeaway? Here's the bottom line. If tariffs fall, imports are likely to surge. There could be global tech benefits, and domestic heavy industry could face pressure. But the biggest driver? The speed of policy response. Markets don't just price outcomes, they price uncertainty. If you want weekly breakdowns of macro policy and market impact, subscribe, follow, and comment below on what you would like us to tackle next.